Well, hey there. Thanks for joining me. Of course, I'm Ted Butler, the voice of Reverse Mortgage with Mutual of Omaha. And I just want to say thank you so much for investing a little bit of time with me in lieu of an in-person meeting. This is a really easy way to be introduced to something called the modern reverse mortgage. It's kind of a fancy initial slide. This is literally a deck that I use in introducing this to my financial planners that I train. But here's where I'd like to start, please. Have a pad and pencil handy, and let's start by writing down this website, if you would. Simply write down www.hud.gov, HUD.gov. And the reason I want us to start here is there really is no other place that you need to go because HUD.gov is the entity that created the modern reverse mortgage. In the search box, simply type in reverse mortgage. And to let you down a little gently, no, there's no Robin Leach lifestyles of the rich and famous, no pictures of champagne wishes or caviar dreams the way you might see on other websites. But what you will find is the federal government has taken the time to put together very thoughtful, well-balanced information about the program that they created. They'll talk about the reasoning behind it, how the program works, even some of the important counseling steps that are part of everybody's process in using the modern reverse mortgage. So even whether I'm working with financial planners or realtors or homeowners, this is the website that I direct them to. So www.hud.gov. But yeah, let's get into this a little bit. Oh, who am I? Okay, I've been doing this for almost 100 years, 23 years to be exact. I entered the reverse mortgage industry through the financial planning door. I was a financial advisor for a leading financial services company. And I've been everywhere and done everything. I've been on TV, radio, you name it. My job really is to educate, and I love that opportunity. The other thing I love are some of the lessons that I learned growing up, and this is something that I never thought would play the role in my life that it did. This was from my parents as they were preparing me to be a fine young gentleman as I grew toward adulthood. And they taught me something very important, and that was that a bad reputation is very easy to gain, but very difficult to get rid of. And if you're like most people, you've heard things about the modern reverse mortgage, and sometimes what we've heard is not very flattering. I will tell you this, there is, even in urban myth, usually a little grain of truth somewhere in there. And we find that often with the modern reverse mortgage. But today we're going to separate fact from fiction, just as I did 24 years ago. And it's no more difficult than keeping a bit of an open mind. Um, and let's just start with a history. Let's provide some context for what we're talking about today. Reverse mortgages are not new in the United States. In fact, the first reverse mortgage was created in 1960 in Portland, Maine. And if you've ever been to Portland, Maine, it's a beautiful little town. They call it the lighthouse capital of the United States. But back in 1960, this was the scene. A widow walks into her local thrift who held her mortgage in tears because with the recent passing of her husband, she can no longer manage the modest monthly mortgage payment. Now, I happen to be somebody who does not believe in coincidence. And it also just so happened that this woman's husband had been the local high school football coach, loved and adored by many in town. And one of the people that loved and adored him had actually played football for him. And that turned out to be none other than the manager of the bank that held her mortgage. He took pity on her situation and told her while he could not forgive her mortgage, he could create a version of the mortgage that would allow her to continue to live in the home, not have to make any sort of monthly mortgage payment, and that the bank would simply continue to charge her interest and then collect those interest payments from her when she was done using the home. The bank knew that they had a secure investment, and she knew that she was going to be able to live in her home without worry financially, and that it was truly an answer to prayer. That was the first reverse mortgage recorded in the United States. But probably not a huge surprise. Banks aren't in the Christian charity business. Oh no, they're in the money-making business, particularly for the bank. And so over a period of time, banks started to tip the table more and more into their favor. And one of the most egregious things that they did in old style reverse mortgages was insert a little bit of contract language called an equity share provision, which meant that not only would the bank expect to get paid the interest that was due at the end, but in their minds, since the homeowner wasn't making a payment, that any growth in that home's value over that period of time, oh, it shouldn't be the homeowners or their families. No, it should be the banks. Believe it or not, it was legal. People signed the contracts. But as you can imagine, at the end, when things had to be settled, there was a lot of shocked and sad families. Once upon a time, groups like AARP were true advocates for senior rights, and AARP led the charge to Washington, D.C., to bring a petition to the federal government to put an end to what had become a predatory lending practice. And the federal government looked at this and said, you know what? No more are we going to allow you banks to take advantage of people like this. So no more of those old style reverse mortgages. But the federal government also realized that the concept of a reverse mortgage could really play a vital role in what the federal government was already aware was happening in the United States. And that was simply the fact that after World War II and the baby boomers, there was not enough of growth in population to be able to handle or sustain the already growing government services, particularly for our aging population. So they realized that if there was a way that they could create a safe version of the bottom reverse mortgage, it would allow countless Americans to remain independent and self-sufficient longer by simply allowing them safe access to one of their most important assets, the very home that they're living in. So what did they do? In 1987, the Department of Housing and Urban Development created a program called the FHA Home Equity Conversion Mortgage Demonstration Act. Oh, just rolls right off the tongue, doesn't it? But it was the government version of a reverse mortgage, this time with all of the protection and guarantee oriented squarely on the shoulders of the senior homeowner. Yes, the banks would get paid fairly, but they wouldn't be able to take advantage of anybody because this was a federal mortgage program and it would be administered and insured by the federal government. In fact, the initial rollout was so successful that in 1988, then President Ronald Reagan actually signed this bill into federal law. So what we talk about today, the modern reverse mortgage, technically called the FHA Home Equity Conversion Mortgage, is unequivocally the safest mortgage in America by far. An amazing program that has had an impact so positively in millions of homeowners' lives and millions more to come. What did this program do? Well, number one, it made sure that the borrower retained title to their own home. So nothing happens to the title, doesn't go to the bank, doesn't go to the government. Just like any other mortgage, you retain title to your property. You also retain full rights and responsibilities of home ownership. Rights meaning, well, you can pay the loan off in part or in full at any point. There's never a prepayment penalty. You can sell the house at any point. And if you should be in the program, when you pass away, the house will go to your heirs, not the bank or the government. And your heirs would pay off the loan or sell the house, pay off the loan, and then your heirs keep any remaining equity. And you can live in the home as long as it's your primary residence until you turn age 150. There's no aging out in this program. Really amazing. It also has some very important safety mechanisms that you don't find on any other mortgage, not the least of which is something that makes this loan what's called non-recourse. Non-recourse means that no matter what happens to home values, no matter if we go through another 2008 with a dramatic drop in home values or worse, your reverse mortgage is protected. You will never owe more than the value of the property, unlike with a conventional mortgage. With a conventional mortgage, if home values drop below what you owe on a mortgage, the bank doesn't care. You still owe them what you owe them, but not with the modern reverse mortgage. The modern reverse mortgage is insured. So if there is a shortfall or deficiency at the end, your heirs will be protected, you will be protected, and of course, the bank is protected. No other mortgage comes with that type of protection. Who uses the program today? Well, it is age restricted, meaning by law, they can discriminate based on age. So to participate with the FHA reverse mortgage, you have to be at least 62 years of age, and you can't be any older than 150. It's in the contract. You can be a single person, married person, widowed, partnered, etc. It can only be used on your primary residence. They don't care how many homes you own, but only on the primary where your credit and driver's license, et cetera, all point to. And as far as the property, as any regular mortgage, a single family residence, which is just a regular house, a condo, as long as it's FHA approved, a duplex, a triplex, a fourplex, even manufactured homes, as long as they were built after June 1977 and you own the land that the manufactured home sits on. The home can be paid off free and clear, or the home can have a mortgage on it. Doesn't matter. Either way, you qualify for the program. And there's no repayment again until the last borrower no longer lives in the home permanently. Now, for most people, they believe that they're going to be in their house when they pass away. But statistics tell us that 80% of us are going to be in a facility at that point. HUD wants to make sure that there'll be plenty of equity left in the house to help you transition to that next place. But as long as you live in the house, there's no need for repayment until you turn age 150. But if you moved out of the house and you've been out of the house for 12 continuous months, well, then the program, which was designed to keep you in your own home, HUD is going to realize is no longer taking place. So they'll require that you repay the loan, which most people would do anyway if they weren't living in the house anymore. How are people using this program today? Well, first and foremost, without a doubt, to pay off a mortgage and get rid of what for many is their largest single monthly expense. Imagine for a moment, if you would, how nice next month would be if you could wake up on the first of the month knowing that you didn't have to make that monthly mortgage payment. That money got to stay in your bank account, and that you knew the following month you didn't have to make that monthly mortgage payment, and the month after that, and the month after that. That gives you a glimpse into some of what the modern reverse mortgage provides people. But getting rid of your largest single monthly expense usually is job number one. But also people use the program for all sorts of things. Home improvement is the number one use of funds. People may have deferred maintenance issues, or they want to age-proof their house, et cetera. Other people are dealing with care issues and bringing home into the care. This can be a great solution for covering the cost of that care. Other people are getting to this point in their life and stuff has happened. So they have credit card bills or medical bills that they need to pay off. Well, people use this program from that. There's no restriction on the use of funds. Some people just use it to live their best life possible. They've got everything buttoned up, but having access to some additional tax-free funds might allow them to travel more, maybe do some gifting, or even purchase a new home. Because yes, you can actually use this program to buy a new house, just like a regular mortgage. Put a certain amount down, the reverse mortgage covers the rest without making a monthly mortgage payment. A lot of people really want to get down to brass tacks and say, well, Ted, how much can I get? Well, that depends. HUD uses a very conservative calculation. They're not going to give you anything close to your home value. They don't think that would be prudent. So HUD has devised a calculation where they're going to look at your age, the appraised value of the home, and a factor they call the expected interest rate. Those three numbers go into their algorithm to compute for you what your number is. It's called the principal limit. That number is going to be anywhere from 30 to 85% of the value of your home. The older you are, the more HUD allows you to have access to. We're going to have closing costs with our mortgage, just like any other mortgage. We're a federal mortgage program, so we're going to have closing costs different than non-federal mortgages, but the same as a VA mortgage or a USDA mortgage or a regular FHA mortgage. There's nothing special or untoward about the closing costs about the modern reverse mortgage. Yes, they're different than a non-government mortgage, but we're a government mortgage, so it's just the same. Again, you retain title, full rights and responsibilities of home ownership. When you pass, the house goes to your heirs, and you have multiple payment options. So you can receive money in a lump sum. You can receive money as a monthly payment to you every month. If you don't need the money, you don't have to take the money. You can leave the money inside the reverse mortgage in something called the reverse mortgage line of credit. And here's something amazing. HUD will actually assign a rate of growth to those unused funds. So think about maybe like a home equity line of credit, but one that magically grows in value for you, has nothing to do about any future home growth. Your home values can go down, and your line of credit is guaranteed by the federal government to continue to grow for you. It's a staggeringly successful part of how the modern reverse mortgage works. And there's all sorts of fancy ways that people use the modern reverse mortgage. We work with people from all walks of life, people with very sophisticated financial background to just what I would call regular folks, people with normal homes to people with multi-million dollar homes. The program is being found to be useful in all walks of life. And we can get into fancy details whenever you feel like it. But today we're going to talk about somebody that I'm going to call Marilyn, and use her as an example because it's a great illustration of how this program can work. And let's just say Marilyn is an average age today for our borrower, which is age 75. And her goal is simply to have a more secure life in retirement. What would that look like? Well, by increasing monthly cash flow, that would be great. And no, we don't mean by Marilyn going back out into the workforce. But how about we get rid of her largest single monthly expense, her mortgage payment? And for many people, that is like going out and getting another full-time job. In this situation, we're going to estimate a home value of $350,000. Going to have a modest mortgage against that home, $52,000. And first thing this program will do is pay off her current mortgage and eliminate that monthly mortgage payment. But there will be funds over and above what's needed to pay off the mortgage. And in Marilyn's situation, that is going to total about $74,000. Now, if Marilyn didn't need that money right now, she doesn't have to take it. She can leave it in the reverse mortgage line of credit, where this week HUD's rate of growth on that line of credit is 6.75%, tax-free, not considered income, 100% FHA insured. Amazing. Nothing else out there like it. Or if extra income was needed or wanted, she could have a lifetime payment of $550 a month tax-free. If that isn't enough, we can calculate a shorter period of time to get more monthly income. Or if cash out is the goal, HUD doesn't give you access to everything you qualify for immediately. They're going to protect you from yourself for a little bit. They don't want you to be too foolish with the use of your funds. So Marilyn, in this instance, could take out up to $17,000 during the first 12 months. And at the end of her one-year contract anniversary, she can have the whole kit and caboodle or any combination of those numbers. And many people will, for instance, take some cash out at close, leave the rest in the line of credit. And HUD allows you to change your payment plan. If your circumstances or needs should change once you're in your reverse mortgage, you can change your payment plan at any point. A tremendous amount of flexibility. It's also important to understand that there's more than just one version of the modern reverse mortgage. Any company that you're working with should show you every version of the program that you qualify for. And in Marilyn's instance, she qualifies for all versions of the FHA reverse mortgage, and you qualify for all interest rates. That's right. You choose the interest rate that you want on your loan. Different than a conventional mortgage where the lender is going to assign you an interest rate based on your income and credit score and risk to the lender. You qualify for everything. We don't have a mortgage payment to try and solve for. So we're not going to be looking at your risk assessment or credit score to determine what your interest rate is. And we're going to show you the impact that the interest rate has. A lower interest rate might be beneficial for somebody who's looking for immediate relief from their reverse mortgage. But at the same time, if you don't need money out of your reverse mortgage right away, you might want the higher interest rate because that will increase the rate of growth on the line of credit if you're thinking about putting it in place today and using it down the road. We have many people that do that. For instance, I'm working with a couple right now, 62, paid off home, still working. They put the reverse mortgage in place today. They ask for the highest interest rate possible because they're not going to think about touching their reverse mortgage for 10 years. At today's current interest rates, their $350,000 line of credit is going to be more like an $800,000 line of credit in 10 years. Pretty amazing compounding. And that's when they plan on starting to access it. Everybody's situation is different, but it's important to know that you're in the driver's seat. You qualify for all versions, you qualify for all interest rates. What we're going to do is we're going to take a quick stroll through the different versions of the FHA reverse mortgage. Now, when HUD created the program originally, they used the same platform that banks use to lend money to other banks, and that was with a variable rate, meaning that interest rate can change. But different than an adjustable rate mortgage. For instance, when I bought my first house, I put the minimum amount down. I got an adjustable rate mortgage, and it was guaranteed for that interest rate to go up at the end of the first year, the second year, the third year, the fifth year. Um, and it worked out great. And it works out great for a lot of people. But for some folks, that increase in interest rate means an increase in a monthly mortgage payment that they might not be able to handle. Again, we have no monthly payment where that interest rate fluctuation is going to impact you. No, but it is how banks lend money to other banks, and it is the platform that HUD used when they created the program. But interestingly, just before the housing collapse in 2007, HUD was under a lot of pressure to provide a fixed rate version of the modern reverse mortgage. Quite interestingly, back then interest rates were around 6.5 to 7.5%, almost exactly where they are today, quite interestingly. But people were concerned that interest rates were going to go up. And so finally HUD said, okay, we'll do a fixed rate version of the FHA reverse mortgage, but none of the math and science that went into creating the regular version of the bottom reverse mortgage applied on a fixed rate platform. So there's no multiple payment options. There's no monthly payment. There's no line of credit. You can only take whatever cash you have available out. And fixed loans by nature are higher interest rate than variable rate loans. And the higher interest rate has a dramatic impact on how much you qualify for. So we don't do very many of those fixed rate FHA reverse mortgages. But it's available to you, and it's important to know that it's there and how it works. But let's take a look at the most common version of the modern reverse mortgage. HECM, remember, stands for Home Equity Conversion Mortgage. That's the acronym for the modern reverse mortgage, HECM. CMT refers to the index that HUD uses, the constant maturity treasury rate. We used to use an index called the LIBOR rate, the London Interbanking Offer Rate, but those naughty Brits got in trouble for playing around with that, and so we can't use that anymore. This loan has a 5% cap. This version of it has a 10% cap. So you can imagine which version most people gravitate toward. Yep, they go to the one that's more conservative. Now, margin is what goes into making up an interest rate. Different margins give us different interest rates. And you're going to notice that there are two interest rates here that HUD is showing you. The initial rate, well, that's going to be what your loan is going to be charged when your reverse mortgage starts. That gets locked 2 days before your loan closes. This version at that margin is a 6% initial rate. This version at that margin is a 6.625% interest rate. 30-year fixed rate mortgage today here in America is about 6.75%. So our interest rates are commensurate with what people would find out in the open market for a conventional mortgage. Our fixed rate reverse mortgage, though, it's higher, 8.75%. But the expected rate, this is the rate that HUD is going to use to determine how much you qualify, not the actual rate. The expected rate is what HUD believes your interest rate is going to average over the life of the loan. Notice right now, it's a little bit higher than where actual interest rates are. This is based on an index called the 10-year Treasury. The 10-year Treasury is the world's index for midterm debt, midterm capital. Nobody uses their own money today. Governments don't use their own money. Businesses don't use their own money. And most people don't use their own money. They borrow money. And the cost of money goes into determining profitability. So the 10-year Treasury, the 10-year swap rate is what most businesses and governments look at to help estimate the cost of capital. And So you're just like the big guys. That's what HUD is going to use in the calculation. Again, age, expected rate, and appraised value. Now, in this instance, Marilyn, who we're looking at age 75, with a $350,000 home is going to qualify for $147,700. Now, out of that, HUD has to account for closing costs. The largest closing cost for all government mortgages is something called the initial mortgage insurance premium. Remember, we have a very special mortgage insurance premium that comes with the FHA reverse mortgage. HUD calculates that at 2%, excuse me, 2% of the appraised value. Now, the borrower doesn't pay that. We pay that to FHA on their behalf, but the borrower will pay that back when they're done using the reverse mortgage. HUD allows the lenders to charge a fee called the origination fee. HUD sets that. And then other fees, this individual lives in the state of Florida. The state of Florida has higher closing costs than almost any other state, but they're going to be the same closing costs that you would find on any mortgage in Florida. That includes property taxes, title insurance, state tax, transfer tax, etc. Oh my gosh, they have a passel of them. And then we are going to be paying off a mortgage, remember, of $52,000. So what Marilyn is going to have access to after freeing herself of her monthly mortgage payment, paying off her current mortgage, she's going to have access to quite a considerable amount of money, $78,563, in fact. Pretty amazing. Now you're going to notice the impact of that slightly higher interest rate in this option. That drops to $69,000 available. And oh, the poor fixed rate at 8.75, that drops the available all the way down to $11,935. And yep, here's another version over here, annually adjusting. That gets dropped down to $56,000 because of its interest rate. So you're going to see an illustration that shows you your choices. Remember, you're in the driver's seat. You decide which version of the program. That's probably going to be based on how you want the reverse mortgage to work, and you're going to choose the interest rate that's available for it. And your lender, by law, is supposed to show you these choices. And the great thing is, you're going to be required to go to a counseling session, usually done over the telephone, with a HUD counselor who's going to check my homework, literally. They're going to make sure that the numbers that we're representing to you are correct and accurate. And the reason the HUD counselor can do that is these aren't Mutual of Omaha numbers. These aren't XYZ company numbers. These are the Department of Housing and Urban Development numbers. We all use the same calculator to determine how your reverse mortgage works for you. And there isn't anything that one lender can offer you that another lender can't. They might not be showing it to you in the same way, but just know that all the options are there for you. Here's an interesting page. It might be a little bit difficult to see, but it's an amortization schedule showing you what your loan is going to look like or projected to look like over time. Now, remember, you're going to have a mortgage balance that's going to grow slightly every month because without making an interest payment, that interest charge is going to be accounted for and it shows up in the loan balance. What we can't show you is going to be the dollar for dollar equivalent of that interest payment that you're not making that stays in your bank account every month. But it is real money. And to be intellectually honest, we have to make sure that we incorporate that in the conversation because the other side of the coin, yes, your mortgage balance is going to grow slightly every month because of the accounting for the interest that you're not paying, but your bank account is also going to be growing every month because of the monthly payment that is not coming out of that account. Hugely powerful to make sure that you look at both sides of that coin. Another interesting thing is that HUD requires that we show your home value grows at the national average of 4%. Now, depending on where you're located, 4%, is a lark. I mean, in some areas here on the West Coast, average home appreciation is 8 to 12%. But in other parts of the country, the Rust Bowl, for instance, I mean, they're lucky if they get 2% home appreciation. But we have to use 4% as a home appreciation number, and you're going to see your property value is expected to be growing over time. And it's interesting. It's that same principle of home appreciation that allows your current mortgage, your conventional mortgage, to work. Do you realize Most people don't realize this, but do you realize that if you were to borrow $300,000, let's say, to buy a house today with a conventional mortgage, that by the time you get done paying that mortgage back, typical period, 30 years, you'll pay the bank back not 300,000, not 400,000, not 500,000, not $600,000, but probably $700,000. Think about that. You will pay the bank $700,000 to purchase a $300,000 house. They don't really stress that when you're signing up for a conventional mortgage, do they? No, they want you to look at the interest rate and maybe your monthly payment, and that's about it. But truth be told, if you look at the amortization schedule that they give you, you will see that over time, you'll pay more than twice the purchase price when you use a conventional mortgage. And that would be crazy, wouldn't it? If after 30 years, your $300,000 house would still only be worth 300,000, but you've actually ended up giving the bank 700,000. But no, the power of home appreciation in America is one of the soundest investments in the entire world. So pretty sure that that home after 30 years is probably going to be worth maybe closer to $900,000. So yes, it makes sense financially to pay $700,000 over 30 years to end up with an investment that's now worth $900,000. It's that exact same principle that allows the reverse mortgage to work. So look at this last column here, equity. Equity is simply the difference between what you owe and what your home value is. That is the money that you would keep if you were to sell your house. So if you start off happy with where your equity is today, look where your equity would be in 10 years, almost $100,000 more than when you started. And in the meantime, you've saved, I don't know, $100,000 more in monthly mortgage payments, a considerable advantage to you, the homeowner. Yes, the bank is going to get paid, but they don't get paid until you're done using the loan. Why are some banks willing to wait? Is that this is the safest mortgage for banks to lend on. But I hate to tell you, kind of going back to our original story about reverse mortgages, banks aren't nearly as worried about safety in most instances. They're worried about profit. So they would much rather sell you a conventional mortgage because they make much more money from you selling you a conventional mortgage than a reverse mortgage. That's why most banks don't offer this program. But there are some banks that prioritize safety, or at least incorporate safety in their product mix. That's why good companies like Mutual of Omaha offer the modern reverse mortgage. Here are a few things to consider as we wrap things up. Number one, again, this is a federal mortgage program. It's not a lender mortgage program. It doesn't matter what company you go to. If it walks like a duck and quacks like a duck, it's a HECM. It's a home equity conversion mortgage. It's going to be the same program, same calculation. The lenders can all offer the exact same interest rates. You choose. You're going to choose the version of the program, the interest rate. And again, there's nothing that one lender can do that another lender cannot. But here's where things start to separate. It's just like if you were to get your car repaired. You can go to this car repair place over here and pay X amount, or you can go over here to a budget car repair place and probably pay less. Which place do you think is going to do a better job for you? The cut rate company or this company? Well, all things considered, it's going to cost you the same with the reverse mortgage, which one you go to. But there are companies out there, let's just say, that do a better job taking care of their clients than other companies. There are companies out there that have only been around for a couple of years. And then there's companies that have been around, oh, I don't know, we've been around for 117 years. Why have we been around for 117 years? Because we have a proven track record of taking care of our clients. Number one, we're a mutual company, meaning we're owned by our policyholders, not by investors on Wall Street. That makes a huge difference in how we orient ourselves to our clients and our customer service. The other question to ask is, who's going to be the person who's actually helping you with your loan? The loan officer plays a critical role in this. What type of experience do they have? Do they do all kinds of mortgages? Well, that's not a good sign because the reverse mortgage is a very specified program and it is not like a conventional mortgage. And it's very, I've never met anybody who is excellent at both. In fact, our company doesn't allow us to do both. You have to decide, are you going to be on the reverse mortgage side of the aisle or the conventional mortgage side of the aisle? And never the twain shall mix for very, very good reasons. Our loan process is much longer and it's much more heavily oriented toward education. The conventional side, the first thing they'll do is they'll send you a link and you sign an application. You can't do that with the modern reverse mortgage until you've completed your counseling session and you know fully what your options are and that you want to proceed. And so finding out how long your loan officer has been doing their job is a really critical part of your success. And with companies like Mutual of Omaha, you would start with a loan officer such as myself, and that loan officer will stay attached to your hip through the entire process. And if it's somebody else like me, I keep in great contact with my clients after the fact. I check in with you 3 months after close, 6 months after close, a year after close, every year, like an annual physical. And Mutual of Omaha has one of the very few companies that actually service their own loans, meaning once you're part of the Mutual of Omaha family, you stay part of the Mutual of Omaha family. That was about as quick a dive into all things modern reverse mortgage as possible. There's going to be questions. Please don't hesitate to reach out to me. Best number to reach me, 425-891-6644. Isn't that funny? 425-891-6644. I don't care how big or small the question is. Give me a call. I'm here to be of service and help you make an informed decision. Thank you for your time.